Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. All right, welcome. Today we're going to tackle one of the more intricate areas of Canadian corporate tax law, the refundable tax system, specifically as it applies to private corporations. Our goal here is to really unpack how this system works and, just as importantly, why it even exists in the first place.
So here's how we're going to break it all down. We'll start with the core problem that this entire system was designed to solve. Then we'll look at the two main tools the government uses to address it. After that, we'll get into the mechanics of how the refund actually works. And finally, we'll step back and ask the big question: does the system actually achieve its goal of tax neutrality? All right, let's jump right in. Before you can understand how refundable taxes work, you absolutely have to understand the foundational principle that drives them. It's a concept called tax integration. This is the why behind this whole complex structure. You see, the whole idea behind tax integration is to keep things fair. It's a principle of neutrality. The total tax bill on a dollar earned should, in theory, be the exact same whether you earn it directly as an individual or if you earn it inside your corporation and then pay it out to yourself. This is to stop people from using a corporation just to get a massive tax break. So, if the goal is this perfect integration, then what's the big problem? Why do we need this whole complicated refundable tax system? Well, the issue isn't really about the total amount of tax paid in the end. It's all about the timing of when that tax gets paid. And that timing difference creates a really powerful opportunity for what we call tax deferral. And this right here, this slide, lays out the problem perfectly. Let's look at Sam. If he earns $100,000 in active business income personally, he pays his personal tax. We'll use 45% for this example, and he's left with $55,000 in his pocket. But look what happens if his corporation, Sam Corp, earns that sum $100,000. It pays a much lower small business tax rate, say 11%. If the corporation just holds on to that money, it has $89,000 in the bank, a huge amount of cash available to reinvest and grow. The personal tax for Sam has been deferred. Now, here's a really critical distinction the government makes. They are generally okay with this deferral on active business income. Why? Because they want to encourage businesses to reinvest their profits, grow their operations, and hire more people. But they are not okay with this deferral when it comes to passive investment income. They don't want corporations to simply become personal investment holding tanks. This type of income gets tracked in a special category called aggregate investment income, or AII. So what exactly is this aggregate investment income, or AII? Well, it's a specific term in the Tax Act that captures most of the typical passive income a corporation might earn. Think things like capital gains, interest income, rent, royalties, that sort of thing. But look closely at what's excluded. It specifically does not include dividends from other Canadian corporations. That's because those are handled by a completely separate but related set of rules that we're going to get to in just a moment. Okay, so how does the government tackle this deferral problem on passive income? Let's dig into the first major tool in their toolbox, and it's a big one. They impose a special, very high rate of tax on that aggregate investment income right up front. Well, they hit it with a really, really high tax rate right out of the gate. We're talking about a combined federal and provincial tax rate of roughly 48.67% on this type of income. Now, that number isn't an accident. It's intentionally set to be around or even higher than the highest personal tax rates. The goal is simple: wipe out any possible tax deferral advantage immediately. Let's put some real numbers to this. Imagine a company, let's call it ABC Corp, earns $100,000 of this aggregate investment income. First, it pays its base Part 1 corporate tax, which is 38%, so that's $38,000. But then, on top of that, it gets hit with this additional refundable tax, or ART, of 10.67%. You add those together, and the immediate tax bill is a whopping $48,667. At a rate like that, there's absolutely no benefit left to holding that money in the corporation. Okay, but here's the twist. And this is really the heart of the whole refundable system. A big chunk of that high tax bill isn't gone forever. It's essentially a prepayment of tax. The government holds on to it, but it's designated as refundable back to the corporation, with one very important string attached. The corporation only gets it back when it pays a dividend out to its shareholder. So going back to our ABC Corp example, of the nearly $49,000 in tax it paid, the law calculates that $30,667 of it is refundable. That amount gets credited to a special account for the corporation. So you can see the strategy here.
The government applies a significant tax up front to neutralize any incentive to hoard passive investments, but it provides a mechanism to get some of that tax back to promote the flow of funds out to shareholders. Okay, but remember how we said Canadian dividends were excluded from that first batch of rules? Well, you can't just leave a loophole that big open. Otherwise, a corporation could just defer tax by investing in shares of other Canadian companies. That's where the second part of the solution comes in. It's called Part 4 tax. Now, the way this Part 4 tax works really hinges on one key question. Are the corporations connected? Basically, does one have significant control or influence over the other? If they're not connected, think of just owning some shares of a public company in your portfolio. The rule is simple. The corporation pays a flat 38.33% tax on the dividends it receives. But if they are connected, the calculation is different. It's designed to just make the refundable tax flow from the subsidiary up to the parent company. This table is a fantastic example because it shows both of these rules playing out side by side. Look at ABC Corp. It gets a $10,000 dividend from a public company where it's not connected. Bam! It pays the flat 38.33% tax, which is $3,833. Then it gets a $50,000 dividend from Private Co., a company it controls. Here, the Part 4 tax is calculated as its 75% share of the dividend refund that Private Co. generated. In total, ABC Corp pays over $18,000 in Part 4 tax, and just like the tax on AII, this entire amount is refundable. So we've got all this tax being paid that's supposed to be refundable. You have the refundable portion of Part 1 tax on the investment income, and now you've got this fully refundable Part 4 tax on dividends. How in the world does the government keep track of it all and make sure it gets paid back correctly? Well, they use a special notional account called the Refundable Dividend Tax on Hand, or RDTOH for short. Well, this is where it gets a little more, shall we say, interesting. Before 2019, it was a bit simpler. There was just one RDTOH account where everything got pooled. But in 2019, the system was split into two separate accounts, an eligible RDTOH and a non-eligible RDTOH. The reason for this change was to better match the type of dividend being paid out with the underlying pool of income it came from, all in the name of achieving a more perfect integration. So how do you actually get the money back? The formula is actually pretty straightforward. When the corporation pays a dividend to its shareholders, it gets a refund. That refund is calculated as 38 1/3% of the dividend it paid. So for every dollar in dividends it pays out, it gets about 38 cents back. Of course, there's a limit. You can't get back more than what's actually in your RDTOH account to begin with. Let's go back to our example with ABC Corp. They've got that $30,667 sitting in their refundable account from the tax on their investment income. So the question is, how much of a dividend do they need to pay to their shareholder, Sally, to get that entire amount back? Well, we just work the formula backwards. We take the refund we want, $30,667, and divide it by 38.33%. And that tells us they need to pay out a dividend of exactly $80,000. That dividend payment is the key that unlocks the refund from the government. All right, we've gone through all the mechanics, the high upfront tax, the two different refundable taxes, the RDTOH accounts, the dividend payments, and the refunds. Now for the big question, the moment of truth. Does it actually work? After all is said and done, does this incredibly complex system achieve its ultimate goal of tax neutrality? Okay, so here's the final scorecard. Let's compare the two scenarios. On one side, we have Sally earning that $100,000 of investment income all by herself. After her personal tax of $45,000, she's left with $55,000. On the other side, she earns it through the corporation. When you add up all the taxes, the corporate tax minus the refund, plus her personal tax on the dividend, the total tax paid is $47,400, leaving her with $50,600. And that quote on the slide really sums it up perfectly. In this case, Sally actually ended up with less cash in her pocket by earning the income through the corporation. The system worked. In fact, it worked so well that it didn't just eliminate the deferral advantage, it created a slight tax disadvantage. The incentive to use a private corporation as a personal investment vehicle has been effectively removed. And this really leads us to our final and perhaps most important question. While this system is clearly very effective at stopping tax deferral on passive income, you have to wonder, with all this complexity, with all the different provincial tax rates that can affect the calculations, is achieving perfect tax neutrality in every single situation even possible, or is it more of a theoretical ideal that we're constantly striving for in practice? It's certainly something to think about.